Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets.
New York coffee. Until the last 3 weeks' action, we had seen a continuation of the resultant move lower from the February to June diamond pattern. The primary target for a move down from this diamond pattern was down in the 156.35 zone, which prices achieved in mid-August. I have retired the secondary hard to reach target down in the 141.80 zone after last week's commentary. Okay, so though we had overall until recently been moving lower, there have been a pair of interesting bullish patterns in September and now October. These consist of the weekly key reversals up made in mid-September as well as the weekly key reversal made up 3 weeks ago. The earlier September one caused a rally that eventually ran out of steam, a little short of the declining medium moving average, currently 158.55. The more recent weekly key reversal up we saw in September punched up through the short medium moving average, currently at 153.75, as well as the declining medium moving average. The first time this has happened since June. However, overhead were 2 significant resistances that capped the move higher, specifically the flatlining long moving average, currently 169.60, and above that, the significant congestion from the 50% Fibonacci line of the May 2019 to February 2022 move at 174 even, with its nearby partner the August 2021 low at 174.5. These are not all there is topside, not all by a long way, as we have further significant overhead resistances which I will detail as and when should we get closer. Last week, the long moving average capped the rising market with a daily key reversal down last Wednesday that turned the market lower, such that we are now testing the declining medium moving average but from the top side. Despite this, there are still 2 further features I would like to discuss and highlight. The first is the possibility of a monthly key reversal in October. So if on Tuesday the 31st of October, that's tomorrow, we either see a close over 154.5 or under 147.20, there won't be on. Right now we are still looking, with just 1 day to go, just about at a possible monthly key reversal for October, despite the fall of the last week and of today. Secondly, I would like you to consider the action since mid-September as a possible ascending scallop pattern. Now, on the face of it, last week's pullback lower may have scuppered such an idea, and for a straight ascending scallop pattern, you'd be right. However, pullbacks such as we saw last week can be a handle, a part of the original pattern before they resume a move high. Indeed, sometimes they turn from being a handle into a new ascending scallop pattern. That being said, there is the possibility that we might see a fall all the way to the lows of October around 147.25, in which case we could look to this having a bearish incentive, this market having a bearish incentive and for prices to continue lower still. It is still very early on, but this pattern does still have merit here, and I would like to explore this more fully once we see such a pattern fully evolve. London coffee. The descending wedge pattern, currently 22.39 to 22.89, had been the dominant pattern here since June, despite it being broken in September. However, this pattern has run its course, and so I have relegated it, though it's still on the chart, as there are 2 possible new patterns emerging that seem to be highly influential, and I'm wondering if they will act together or fight it out. The first pattern is one I had previously mentioned 2 weeks ago, and is now it's actually how the original descending wedge pattern had morphed into another bearish pattern, in this case a bear channel, currently 21.73 to 25.28, which I have highlighted this week in green on my daily chart. Secondly, and this idea has only really formulated itself over the last 3 weeks, and it's to look at the action throughout October as a possible ascending scallop pattern. Last week this idea had merit, perhaps not so much this week. However, much as I pointed out in New York Sugar, an ascending scallop pattern may have pullbacks such as we saw last week. Though, to be honest, the pullbacks look a bit excessive for such a pattern. But anyway, these pullbacks can form a handle. Sometimes they turn from being a handle into a new ascending scallop pattern. Now, that being said, there is a distinct possibility that we might see a proper fall to the lows of October around 22.25, in which case we could look to this market renewing its bearish incentive with a break lower from an ascending scallop pattern and for prices to continue further down. It is still very early on to suggest this move lower, but you should be aware of it in case the handle does not materialize. That being said, the bear channel, highlighted in green, has shown once again how effective a cap and maybe a support it can be on this market. And the upper bear channel line and the lower bear channel line are moving lower each day.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.